What's up, everybody? This is Greg. We're going to talk today about something that everybody has, and sadly, they're no fun. Medical bills. Now, I've always been a believer that there are two ways to make money. You can either increase your income or you can decrease your expenses. Sadly, some of those things we just don't have control over, like medical bills. Like, I can't control if my 4-year-old decides to run over my 2-year-old in a little tight car and ends up fracturing her leg. True story. Really did happen. There are two ways, easy ways, that we can decrease our medical expenses. First, one is by using an HSA, or a health savings account. This is a tool that the government has allowed us to use, gives us a tax incentive. So if we contribute to an HSA, we are not taxed on the money that we contribute. This obviously decreases our expenses. So at the end of the year, we make more money. In 2020, the limit for contributing to an HSA is $7,100. So let's do some math. If you contribute $7,100 into a HSA and your tax bracket is, just for the sake of easy math, 20%, that saves you $1,420. I don't know about you, but $1,400, that's no small chunk of change. I would love to have that extra money in my pocket, and so I contribute fully. I max out my HSA every single year. It allows me to keep more money in my pocket, and it allows me to have peace of mind knowing that if I ever have a medical emergency, or if one of my kids breaks a leg, I can go and I can pay for that. I already have the money set aside for it. It's no problem. I'm not scraping for money when I'm getting a paycheck and then paying medical bills over time and incurring interest. So not only does it save you in your tax rate, but also saves you interest that you may have to pay if you have to put it on a payment plan with the hospital that you've used. Another really cool aspect of having an HSA is that's the way you end up paying your medical bills. So you contribute the money tax-free. Anytime you are paying a qualified medical expense, you get the money back out and you get it tax-free. You're not taxed on any of the money that you pull out. And so with the hospitals or with any clinics that you have, a lot of the time they will give a cash discount. So anytime you pay with cash, they're going to allow you to take a discount. People probably don't use this or don't know that, but all you have to do is ask. So we've done it pretty often where we'll have a medical bill and we're like, hey, we have this money set aside in an HSA. It's there, it's ready. We can give it to the hospital and pay off our medical bill. We know that. So hospitals don't love to just put people on collection plans because it takes time, they don't get their money quicker. And so we go to the hospital and we say, hey, if we pay you today in cash, can we have a discount? And oftentimes they will. They'll give you a 10 to 15, maybe even 25% discount. An HSA acts just like cash. You have a debit card, essentially, and that's what your HSA is. So you can use that debit card, they get cash. It is a smart move for them to give you a discount. So not only does it save you on your tax bracket, but it also saves you on a discount. Alright, now that we've established the benefits of an HSA, let's talk about how to contribute to an HSA. A lot of employers actually offer an HSA. Well, they'll contribute money for you. You can also deduct it from your payroll. You can contribute more money on your own in addition to the money that they contribute to for you. If that's not the case, you can always go open a health savings account on your own. So for me, for example, I have one. It's with a company called Health Equity, and I contribute $590 each month. If I can contribute $590 every month, then at the end of the year, I have reached my maximum of $7,100. It is to note that $7,100 is the limit for a family. So if you are single, 1, I'm sorry, married life kind of rocks. 2, you can only contribute $3,550, so half of what families can contribute into an HSA. If you're thinking to yourself, I can't contribute $590 every month because I don't have that type of cash flow, that's all right. Maybe start with a smaller amount. Start contributing $100 a month and build up to that. The cool thing is, if you ever end up having a medical expense, just having that HSA available and ready to put into can save you money. So instead of saying, all right, I've got this medical expense, I need to pay it, I'm just going to take it out of my own checking account, I'm going to pay it, you'd be better served by first contributing it to your HSA and then taking it and paying off the hospital, because you are going to save your money. You're going to save tax money. Even if it's not the full $7,100, you can at least save it on that $300 that you just paid because your son broke his arm or because you got sick and needed to go to the hospital. In addition to HSAs being a fantastic way to save on your taxes now and to pay off medical bills, and also to use them as leverage to reduce your medical bills by negotiating with the hospital for lower rates, they are a fantastic investment tool. So, similar to an IRA, they are contributed pre-tax. That means you are not taxed on the money that you contribute into your HSA. And also similar to a Roth IRA, they are not taxed on the gain that they have while being invested with this health savings account. So many health savings accounts allow you to invest your health savings money into an investment account while you're not using it. This allows it to grow over time and to be able to be used as an investment account. When you pull it out for a qualified medical expense, you are not taxed on it. So you are not taxed on the money you put in. You're not taxed on any gain. You're not taxed on the withdrawal when you withdraw for a qualified medical expense. You can also use it as a regular retirement account when you reach retirement age. You can pull money from it. If you pull it for non-medical reasons, sadly, you're taxed on it. But if you pull it for medical reasons, you are never taxed on it. You're never taxed on the gain that you receive from any investments while it's in your HSA. You might be thinking, then why don't I just put into like a regular IRA or a Roth IRA and just have that as my retirement account? Because if I'm going to be taxed on a health savings account when I pull it out, just like I would be on some of those other ones, then, hey, what's the point? But as we all get older, sadly, medical expenses go up. So it's smart to max out our HSA now, because then we can always pull that money later. Because remember, if it's a qualified medical expense, it is always tax-free, which is awesome. As explained, many health savings accounts allow you to invest money while it is in their health savings account. Mine, for example, Health Equity, they have a limit. They say $2,000, anything below that we're not going to allow you to invest, but anything above that, you can invest into accounts, and I get to choose those accounts. So for me personally, I say I want that cash to be able to pay my deductible. So whatever my insurance deductible is that year, I leave that amount of cash in my HSA. Anything above that, I invest. I invest in these mutual funds with them so that it can grow over time. I do this mostly just for one reason, peace of mind, knowing that I always have the cash on hand to pay for any medical expenses. Now, if I invested all of my balance except for that $2,000 that Health Equity doesn't allow me to invest, then if the stock market tanked, fumbled. So if the stock market tanked and my balance in my HSA just got driven way down, and then I had a medical expense and I didn't have enough money to cover my deductible, then yeah, I would have to pull money from my own bank account to be able to pay that deductible. So I leave the amount of my deductible in my HSA for cash, and then anything in excess of that, I invest. That way it can grow, but I also still have the peace of mind that, hey, if crap happens, I can handle it. If you find this information useful, hit that thumbs up button, give it a like. It allows the internet to know, hey, this is something that could benefit people. Also subscribe to the channel. I'd love to give you more tips. My channel will be focused on 1, increasing our income, and 2, decreasing our expenses, because that's how we make more money. In conclusion, HSAs are a fantastic tool to use. They save us money now because they are reducing our taxes. They allow us to use negotiation with the hospital because we are going to pay cash for our medical expenses when we use our HSA. And they're a fantastic investing tool. They can be used in retirement. They can grow tax-free. So they have the benefits of a traditional IRA and the benefits of a Roth IRA when we use them for qualified medical expenses. I talk to a lot of people about personal finance, and I found that one of the most underutilized tools out there is a health savings account. They are very useful. I would encourage everyone, if you do not have one, to go get one and start contributing. Once again, if you guys have found this information useful, please subscribe, and I'll catch you guys next time.